It's not about what you have. It's about who you have. It's not about where you live. It's about how you live. And it's not about what you do. It's about why you do it. Welcome to the Momenticize podcast. Today, we've got a really, really special guest. We get to dive into the mind of a 27-year-old who has now managed to put together $50 million of assets under management. We get to understand his stint that he had with Grant Cardone, what it took before he was with Grant Cardone, how he became the number one sales guy to raise capital for Cardone Capital, and then what it was like when he decided to go on his own and how he accumulated $50 million worth of assets under management in just 3 years. Without further ado, please help me welcome Gabe Bowling to the podcast.
Man, thank you so much, Dirk, for having me. It's a pleasure to be here. I'm excited to spend as much time as you want. We'll go as deep as you want. And I'm super, super excited to be here. Thank you very much.
I love it. Well, I cannot wait to unpack, what's going on with you. I just want to start off. I mean, you're 27 years old. You've now got $50 million worth of assets under management. You've done that through 4 deals. Can you just tell us a little bit about how that unfolded and just give us the backstory?
Yeah. So I'll give you a quick summary on the $50 million of deals, because that's what most people, want to hear first. And then I'll kind of backstory of it didn't start there. I'm just a normal guy. So a lot of people know me for working at Grant Cardone's office, Cardone Capital. I worked on his real estate team for 3 years, and that's how I got the exposure to the business of buying assets, raising money from outside investors, and really building out a private equity firm. So I was there for 3 years, and I started at 21 and I left at 24. I got my little, that was my grunt or my stint in the trenches and being around people that were making a bunch of money and just going through the process. And in 2022, I decided to leave because, everybody was playing musical chairs, interest rates were super cheap, and everybody was making a ton of money, right in front of my face. So I took the leap. That was a really big risk that my wife and I decided to do. And then I don't want to say I got lucky. I think that preparation and timing is the definition of luck. So I was prepared to go out and start looking for smaller 24 to 48 unit deals. That was my buy box. I wanted to be the value add investor, do a couple of deals, and then move into larger 100 to 200 unit deals. I quit on February 1st of 2022. I got an email from Marcus and Millichap on February 4th saying, here's a new 55 unit deal that's just hit the market. It's for sale. It's awesome townhome product. There's a lot of upside, and the guys are motivated to sell before the rates are going all, through the roof. So first deal came out. I had partners at this time because I was at Grants. I was like, okay, well, I'm not going to be able to do these deals alone. I need help from people, and I need to know what I'm doing. So I was fairly educated. I could underwrite the deal. I could understand investor returns. I knew what got investors excited. So that was my target. I wanted to hit a 2x to the investors. Cool. Now let me go out and find the deal. I quit on Feb 1. I get an email on Feb 4. I take it through my process. Here's the underwriting. Here's the deal. It looks really good. And then I end up taking it to my network of investors. I partner with a guy named Ken Gee. He runs a big management company and firm as well. Got $250 million of assets. The deal was too small for him to pay attention to, but it was a really good deal and he needed to place some equity. So I found it. I raised $1 million for my first deal, and then I had a backstop. So I brought him in to backstop the equity, and I'm taking on a lot of the responsibility because it's a smaller 55 unit deal. That was how I did my first one. And then fast forward to the end of 2023, a seller financed opportunity. It was a 152 unit seller financed deal out in Missouri. We bought that thing for $7.75 million. That was a unicorn because 23 was extremely tough to transact on. The owners were 84 and 85, owned it for 50 or 60 years, ready to move on. The traditional, story that you're looking for in the business as value add investors. They ended up doing a 75% carry on the loan. We raised $2 million for it. We bought it for $7.75. We've owned it for less than a year. We have an appraisal for $12.5. Super excited for that one. And then my third deal was a brand new 2023 product. I think this is one of the first quote unquote recession deals that a lot of people are, going out and pounding their chest about. We bought this from the merchant developer that built it, and they started in the middle of the, in the interest rate environment, 22. Interest rates and insurance caught up to them. Their time ran out on their loan, and they needed to sell it very quickly. So I brought in a partner. We were able to move quickly. And during a time where nobody was able to transact on a deal, having the money already pre-committed in a fund was one of the biggest reasons we were able to get it. We closed on that thing in March of 2024, and let's just say we stole it. I can't really go into how much they ended up losing on it, but we got a really good deal. And then I just did my fourth deal, and we closed on September 6th. It was a baby little 28-unit townhome deal in Ocala, Florida, the middle secondary market here. And that one was similar story. The guys bought it. It's 85 townhome product. They bought it in 22. They did a great job for their business plan. Interest rates caught up to them. They were borrowing on floating rate debt. They were actually in default. They had to get the loan modified, extended 90 days to sell it to us. So the last two deals that we did, I earmarked those as like the recession deals. But that's like the quick synopsis on the four deals that we've done.
Boom, shaka, laka. I love it, man. That's a great synopsis. Congratulations on that, right? Because I think that, it's super impressive. What I want to understand is that moment that you did decide. You said it was a difficult decision from working for Grant Cardone from when you were 21 to then at 24 making the leap and going for it. What was that like mentally, and what made you go for it in the long run?
Yeah. So to give context on why it was such a big risk, it wasn't like I was making, 50 or 60 grand a year and I just hated my job. Like in that case, it makes a lot of sense for people to take risk and take the leap and find a new vehicle. I had what I like to call golden handcuffs because I was in early enough where I was the top guy. I was raising 50 million. I raised 50 million bucks in my last year there, and I was like the top guy. I was making 250 grand a year. So at the 24, making 200, 250 and making good money, I was in early enough, but I wasn't an executive. And I knew I would be good, but I knew that I would hit a lid. And that lid was what ultimately led to me ending up quitting. It took me 6 months to make that decision and like building up the confidence and a little bit of liquidity and a lot of walks with my wife. And we ended up coming to the decision like this. What is the absolute worst case scenario? If you do give up this opportunity, you go out, everything fails, it falls apart, and you end up going and getting another job. Well, we have a resume that says I raised 100 million bucks at Grants, this top person. I know that I have a valuable skill set that if I do fail, I can go get another job working at a private equity firm that wants to raise some money, and I can get back to my 200 grand. Cool. That's worst case scenario. Best case scenario, I didn't even I couldn't even imagine what we're doing today. And it's kind of turned into the best case scenario. So what's the worst case? What's the downside in the deal? What's the risk? And then what's the upside? Is the upside worth taking the risk? And we ended up saying yes. And it starts with my wife. I met my wife almost 7 years ago, and we came up in the middle class. We didn't have much, but we didn't grow up in poverty. We just didn't have freedom. We were the broken middle class mentality. We just wanted to create an incredibly successful life together. That was what we started this journey off as. And we've been together ever since.
I love it, man. I love it. Isn't it? It's the key to any strong man. There's an amazingly strong woman behind that. And it's the same thing for me. Every decision I've ever made, any time I've gone for something, it's because I've had my wife to back me and support me, right? It's like a superpower having a strong wife.
Yeah, you 100%. I can if you look at my life on a graph, I'm like going through the lines. It's just going through the motions. I'm showing up. I know I have a lot more potential, but I don't know how to tap into it. If you pinpoint, I met my wife at the gym in 2018. My life on a graph from 2018 to where we're at now has always been up and to the right. And I think it's because of her.
I couldn't agree more, man. And I'm so glad you have the awareness around that. Before you got the Grant Cardone gig, did you go to college, or what did you do before you got the Grant Cardone gig?
Yeah. So to give some context, I grew up in a middle class household. My mom's the best stay-at-home mom in the entire world. My best friend, still talk to her almost every day. My dad's a Green Beret in the Special Forces. He's still in. He's been in for 27 years. He's a colonel, making 150 to 200. So that was like our life. I didn't have to go and work a lot. I just went to school. I went, got good grades. I played sports, and I didn't get in too much trouble. And I was going through the motions with the end of the tunnel being go to college, get a 4-year degree, get a job, get a family, and the whole shebang. When I got to college, first I played baseball and football my entire life. That was my obsession. I have this extreme. If I do something, I am 100 million% all the way in, or I'm 100 million% not all the way in. There's no middle ground for me. When I got to college, that was my first taste of freedom because I wasn't good enough to go and play baseball at any college. That was like a big ego hit to me. I was like, what do I want to do with my life? I was lost. I didn't really have that obsession that I could just allocate all my time and attention into. I got into some trouble. I almost failed out. And then I ended up moving back in with my parents because it was like I didn't know what freedom really was. I ended up finding bodybuilding. And that was the thing that let me to like, okay, now I can channel all my attention and obsession into one thing. I hated college. I didn't agree with it. I don't think you need like we have guys. I have a 24-year-old that made 250 grand on a 12-unit flip that he bought in 8 months. Like I think that there's more ways that you can make money unless you want to grow up and be the doctor and you want to grow up and be the attorney. You should go get a specialized skill set that takes 4 to 8 years to develop. Great, that's perfect. But if you're just going through the motions, I don't think college is the route. In my family, the way that I was growing up, I had to go to college and go through the motions to get my little, hey, can I get the credit card so I can go get gas? Or hey, can you pay my rent? If I wasn't going to college, I couldn't have that. So I had to make a decision. I was like, I literally went to Google. I went to Google and I said, what career fields can I make the most money in without a college degree? It was automotive sales, insurance, and real estate. Like, all right, well, I don't like the first two. Let's go to real estate. I get my license. I failed 3 times. I passed on the 4th, and nobody wanted to hire a brand new 20 or 19 or 20-year-old with no experience, no value, and just passed his license. So I cold called people. At this time, I'm going through self-development. I'm trying to change my life. I'm reading books. I'm trying to get around people that are doing more than me. That was really important. And I remember listening to Grant. He's like, you have to be different. Don't do what everybody else is doing. You have to stand out. So picked up the phone, cold called every brokerage. My name's Gabe Bowling. I'm a 20-year-old hungry guy. I just got my real estate license. Are you willing to hire me? Or can I come and be a part of your brokerage so I can hit the ground running? Everybody said no, except for Marcus and Millichap. I got lucky. Again, it was just they needed to fill spots with people. And I couldn't even get, at the time, they had what's called a sales intern program, or it's a SIP position, where they'll pay you $8 an hour. They'll hire people out of college, pay them $8 an hour, and then you get to be mentored around people that are doing it. I couldn't even land that job. They wouldn't accept it. They wouldn't pay me $8 an hour. The only way I got it was working for free. So I was like, what are my assets and what are my liabilities? Not, financially or physically, but like internally, how much value do I provide to a company like that? And why in the world would they ever give me the time and train me and develop me into a broker? Well, I can work for free. The downside for them is nothing. Just some random 20-year-old running around the office asking questions. That's the downside. What's the upside? They get to make extra money that I produce for the company. Fantastic. So that was my way in. I cold called. I'm hungry. I'm young. I'm willing to do whatever it takes. I'll eat shit. I apologize, my French, but I'll eat shit. I'll do whatever it takes. Just give me an opportunity, get my foot in the door. And that was my first big win. I was looking for something to allow some momentum to be created. That was my first one. I worked there for free for an entire year. I learned what cap rate was, or I thought I learned what cap rate was. I was meeting brokers that were making $1 million. Like, it was awesome. That was my first real experience to business. I wasn't making any money, but I was developing myself into the person that I wanted to become. And that year of experience was one of the only reasons that I was able to get hired on to Cardone Capital. So I got this big momentum breakout in this free job. Most people aren't going to do that because they want it now. I didn't care because I was like, all right, if I make 50 grand this year, I'm still going to be broke the following. Like, it's not going to change my life if I get a salary today. I'm looking for the experience. So I leveraged that experience, just enough experience and just enough hunger for to be qualified to be hired by Grant. Like, that's the qualifications. He's not going to hire super, super, super smart people because they have opinions, but they look for very young and hungry people that are willing to hit the phones a lot. So I fit the bill and knew just enough about real estate to sound sophisticated.
I love it, man. I love it. Thank you for sharing that story. I think a lot of times there's a disconnect between if you want something, what it takes, right? And working for free for a year. I mean, a lot of people aren't willing. They want the big thing, but they're not willing to put in all the work that it takes to get there, right? And especially if you don't have an in, like I'm very blessed, right? I have an infrastructure. I was born in infrastructure. I'm grateful and blessed for it. But for somebody like you, where you're not born into it, what you have to do then, and the work that you have to put in, and the willingness that you have to put in to get where you want to go, there's a substantial amount of pain you have to go through before you get to where you want
Yeah.
to go. So I commend you for that, right? Because most people would be like, hey, and I'm sure there were people in your life, they're like, hey, what's Gabe doing? Like, he's wasting his time. He's got no money coming in. He's 20 years old. He's a college dropout. What is he doing, right? And now you're in a place where that script is now completely flipped. You stayed with it. You're making more money than probably most of the people who went to college are ever going to make
In a month.
by the time you're 24. And then now all of a sudden you took a huge leap after, like, I like that golden handcuff story. You took a huge leap of faith to go on your own, and boom, look, 3 years later, look what you've created. So I commend you for that, man. I think it's really, really cool. And I think it's important for people to understand the amount of sacrifices that have had to be made for you to get to where you are today.
Yeah, well, thank you for pointing that out. Social media does a terrible job at telling the truth and managing expectations on what's required. Because you see a lot of flashiness. You see me today at 50 million at 27. It sounds really great on paper, but people don't see that it started with eating absolutely anything at 20 just to get enough experience to get into that other thing. And then I was like, when I got to Grant, I knew that I wasn't going to be there forever. So it was like, how long am I going to be here before I take that next step? So I think in 5-year decisions. Like, don't make decisions on 1 year things. Make decisions on 5-year decisions. I've been doing that for a very long period of time. In fact, something I'll mention that changed the way I thought about it. The first mentor I ever had, which was Steve Ekovich at Marcus and Millichap. He was the group that I was working at. The first thing he said, he could tell I was young. The only reason he brought me onto his team was because I was a bodybuilder. He was like, dude, you have the discipline for you to get in that good of shape. Yeah, I want that. I'm going to help you channel this discipline into real estate so you can create a successful business. He told me the first thing, if you want to make a lot of money, just be okay making nothing in year one, and be okay with delaying the instant gratification. Delayed instant gratification. People want it now. The longer you can delay the gratification, the bigger the payoff will be. And I've always had that in the back of my mind.
Yeah, I love it. And he's so right. Being a business owner myself, when I'm looking at resumes or hiring people, I do not look at your college experience. I do not look at that. I look for the kind of the same thing you said. I look for something that's different in the person, right? Something that they can bring to the team. They have to be a cultural fit, but then what's different about them? What's their mindset like? Do they live a growth mindset? Are they disciplined? If you have somebody who's disciplined and they have a growth mindset, the sky's the limit. The sky is the limit. If you have a good vehicle, you have a good company and a good vision, then all you need is people who have a growth mindset and they have discipline and they have a big vision for themselves as well, right? So it's so true. I think if you're young and you're trying to figure out how do you get into these groups, if you work on your discipline, that will become your destiny. The more disciplined you can become, the better your destiny will become. It's so true. I mean, that's why, like you said, he took a chance on you because he saw how disciplined you were in the bodybuilding side. Okay, I want to go now deep. Thanks for the backstory. I love it, man.
Yeah.
And congrats. I really love it. I want to go deep into now the deals themselves, because in every deal there's the property, there's the sellers of the property, there's the buyers of the property, and there's the deal maker. And you've become really, really good at becoming the deal maker, raising the capital, doing the underwriting. You're a great deal maker. You can see that because you're 27. You have $50 million of real estate under your management. Talk to me a little bit about what it takes to be a good deal maker.
Yeah, two things. Proper education. Like, so many people discount the level and the degree of experience and diligence you need to take to properly make a decision in any deal. Like, it's not as simple as back of the napkin, 5-minute, pen the paper. Okay, it looks great. Let's shoot from the hip. Let's figure it out along the way. That is not how you fly in this business. So learning the micro little, the minutia, every single line item, insurance, and where did the insurance quote come from, and then taxes, and then where did it come from, the tax assessor's website, or like, we're looking at every single line item in the detail to calculate risk. It's education and people. Like, if you really simplify it to two things, if you know what you're looking for, like I look for 15 to 20% IRRs over a 5-year hold period. And that's net to the LP. That is my target, and that is education. If I have the education, I know my target, then I'm going to hit the next barrier, which is people. I can find the deals. I can have the deal flow. I can size it up, no problem. The deal makes sense at here. And then you hit a barrier. Can you submit the offer? And then can you actually execute on the deal? If you don't have the people in your network, you're not going to be able to do it. You're going to be the person that knows how to underwrite every single deal in the world, but gets stuck at submitting your LOI if you don't have the network. So,
Gabe, real quick, because I want to just touch base. You said, your buy box, essentially what you're targeting is 15 to 20% IRR. What is IRR? Just hit
yeah,
IRR.
so it's an investment metric. So there's annualized returns and then there's internal rate of returns.
Yep.
Annualized. So if you give me $100,000 and I send you back $200,000 over a 5-year period, that's 100% profit over a 5-year period. That's 20% per year. That is the annualized return. Internal rate of return takes into account time value of money. So it's an investment metric that investors look at, because if they're locking their money up for 5 years, they're missing other opportunities and money. It's just I could go super deep, but I'll leave it as simple as that. It's an investment metric that investors look at. They don't. AAR is more of an accounting metric. Investor metrics is IRR. Meaning
it stands for internal rate of return, so everybody understands. And it's exactly. It's a way for investors to compare the deal that Gabe is bringing to them against the deal that I'm bringing to them.
Yes.
Right, because it includes the time value of money, like Gabe mentioned, into how long you're trying to hold the deal, what your business plan says. You might have a 5-year business plan. I might have a 10-year business plan, and that'll impact the way that your internal rate of return will play out.
Yeah, 100%. And then equity multiple is where I like to simplify it at. You give me 100, I send you back 200 over what hold period? 3 to 5. Great. Yep. So between the cash, I'm paying 6 to 8 for the investors every year.
6 to 8% cash on cash return.
Yep, 6 to 8 cash on cash, and that's paid monthly. One big thing I found out at Grant's office, if you're going to go out and raise a bunch of money from retail investors, paying monthly is one of the biggest hits that people like. Everybody likes to be paid monthly.
Yeah, it's an upside rather than doing the quarterly payouts. Mm-hmm. Having it monthly creates the monthly cash flow for them.
Yep.
Just feels good. They get to see it every single month. It's a good.
It's like the high yield Amex account or an Ally account. They put the money in. They're like, oh, the money's going to work, and it shows up every month. But yeah, that's it. I hit a 2x. That is my goal whenever I underwrite. Everything's got to be based on proven factual numbers today. Like we all project what future NOI is going to look like after we're done with the business plan or after you're done building. Like rents will be here, expenses will be here. This is what the income will be. I think the building is going to be worth this. You're probably not told this often, but 100% of the time, whenever you underwrite, you're going to be wrong. Like 100,000,000% of the time. It's just, are you wrong in the good way or are you wrong in the bad way? I always want to be on the side of, I know I'm going to be wrong in the good way, but what I'm projecting is a very conservative number. Like that's my approach with it.
Yeah, I couldn't agree more. We run it on like 3 scenarios. Pessimistically, what does this look like? Realistically, what does this look like? And then optimistically, what does this look like? And if we're okay with the pessimistic scenario, then we look at that. We say, okay, we really stress test the crap out of that deal. If we're okay with that, okay, that makes us feel good. It's the deals where you fudge the numbers because you really want it to happen. Those are the deals that go wrong, right? I mean, that's how you picked up in 2023. That's how you picked up a brand new construction for below its replacement cost, right?
Yeah, we paid $235 a unit, and rents are $2,000 right this second.
And I bet you it cost them so replacement cost. Just so everybody knows, it's if you were to have to build that building all over again, what would it cost today to replace the building? And Gabe picked that up below replacement cost. I can almost guarantee you, knowing that he paid $235,000 a unit. And so, and plus with that, like a quick back of the napkin, because there was one thing you said, and I disagree and agree with you. I disagree because I think you have to be able to act quick and use back of the napkin simple formulas to understand whether or not you want to look at a deal. Otherwise, if you were to underwrite every deal in really big depth, you're going to lose the deal right away. Paralysis by analysis. So you have to have a couple key metrics to then be able to make your offer, tie it up. And then, like you said, during due diligence, it is just fine tooth comb, right?
Yes.
So one of the back of the napkin things that we use would be what we call the 1% rule. So if you can get a deal where you can have rents be 1% of your purchase price, you're going to be in a good position. I mean, it's really difficult to get unless you go into certain markets, but let's just play out that great deal, which is a new construction deal. You picked it up for $235 a unit, and you're getting 19. Aren't you getting 1975 or so?
$2,000.
$2,000. So you're getting $2,000. So you're extremely close within that 1% rule. And so right there, right away, we know that they're probably, I don't know how much cash you put in, but you're probably, making somewhere in that 6% cash on cash
Yep.
return. So you're cash
Yep.
flowing really nicely. I don't know what kind of debt structure you have, but you just know right there, right away, because it's so close. $235,000 was their purchase price. They're getting $2,000 in rent.
Yep.
It's really close to that 1% rule, so it's worth looking at, right? And I think
Completely.
that you do have to have those, like you said, the education piece. You have to learn those quick metrics to understand if it's even worth going deep on a deal.
Completely agree. I will back you. I mismanaged my own expectations whenever I said it. 5 minute, like I'm not going to waste time on stuff that I know is not real. So why are they selling is a big question I ask. If they're not motivated to sell and get out of it, I'm going to let the market speak first. And they're like, okay, are they overpricing it? If they don't need to sell, do they sell today after the market speaks? If they need to sell and I do my 5 minute. So a key metric, I look for at least neutral or positive leverage plus $200 to $300 of upside on a value add deal. If I can be neutrally leveraged with $300 of upside, I'm going to hit my returns. If I have 100 points of positive leverage with $100 of upside, I'm going to hit my returns. If I'm negative, that's a red flag in the deal.
Yeah, I love it. I love it. Yeah. And so the next piece you talked about, I wanted to break down that IRR. We went a little bit into the rabbit hole of numbers because we love them. That's just how it goes. You talked about people. So they're part of being a deal maker is the people side. Tell me a little bit more about that.
Understanding how puzzles work and your skill set and how you can find a complementary skill set. So like for me, I can put a deal together because I see somebody's a capital raiser and then somebody's an operator that's a really good operator. They're really good at making the deal work and executing the business plan. And then we have somebody that's not so great of an operator because they're a networker or they go out there, they have access to a lot of capital. So it's simply putting together the operator with the capital raiser and putting it under one roof, and that roof is the deal. And having somebody, so if like for us, the people I've partnered with, I've strategically partnered with people that own and integrate their third-party property management internally for their own firm so that I could learn the operations as well. So for me, I knew that I could raise some capital because I raised $100 million at Grant. I know a thing or two about a funnel. I've raised $7 million of equity today from retail investors with my name on the line at a young age. If I can leverage somebody else's operating experience to borrow their track record, it makes the investor feel a lot more comfortable to put money in with me because they're taking a risk on me, but it's backed by somebody that has 25 years of experience. That was how I raised a lot of the money because I'm partnering with these strategic people to complement my downside. Being so young, yes, working at Grants did not make me a good investor. I knew the back of the napkin stuff. I knew what actually went into making a deal, but I wasn't on the acquisitions team sizing everything up and doing all the stuff that we do today. So it was limited visibility. I didn't know all of it until I got into deals with people that have already done it for 25 years, and I compressed what took me 2.5, almost 3 years. It probably would have taken me 20 years of going through learning experiences and finding out the hard way. I would just skipped all that and got a really good partner. So I see people that are capital raiser, like they're connected with people. They can raise some money, but they've never done a deal. They've never operated it. That does not work because that's the same avatar. If you have a deal, if you have an operator, they got the experience, they can execute it. And then we have the investors over here that those two puzzle pieces, they fit. So that's what I mean for network. It has to fit the deal.
I love it. I love it, man. Yeah, it's the whole thing. Like real estate is a relationship game, and having the right team members on the team is key. I couldn't agree more with you on that. I want to touch a little bit on being that deal maker, right? Like you said, you got the experienced people in there, and then what you were really, really great at, you know how to underwrite, and then you know how to raise capital like a madman because you raised $100 million. I mean, congrats on that. That's a big deal. Tell me about a good deal comes in.
Yep.
It's time to raise capital.
Yep.
Break it down for me, Gabe.
So before the deal comes in, you should already be talking to investor because before the deal comes in, let's call it how it is. You're not going to get into the business, find a deal, submit an offer, and then that's your very first one. Like you're going to get into the business and put like 10 or 20 or 30, like you're going to get told no a lot. Yeah, like a lot. We looked at a lot of deals to land on the first one, especially the ones that we do now. Like in the market we're in, I look at a lot of deals to land on a lot of hopes of somebody wanting to sell at the price that makes sense for me, but it never happens. So be prepared for that. As you're doing it, you can leverage it and have the exact same conversations that you're going to have with the investors that you're trying to raise money from anyways. Trust is the biggest reason people invest with you or don't invest with you. Like I could bring a deal that has a 5x equity multiple. It looks insanely awesome on paper, and they might take the risk on me if they don't know me, they don't trust me because of how good the deal is. But I could also bring out a 2x with much less return, and the investor that trusts me, that doesn't want to have to go out and find a new operator, a new person to get in bed with, they're just going to write the check. And so before you're even going out to deals, you're planting the seeds. Hey, John, this is the last deal that I just submitted an offer on. Unfortunately, because my discipline is so high, I couldn't get to the price that the other person got it at. Guess what that's doing? That's telling the investor that you have discipline. But this is what it would have looked like if we got the deal at the price that made sense. This is how it would work from the business plan. It looks like this. We're going to make it look like this. If all that happens, then the returns should be this. Our targeted return, 6%, blah, 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 blah. So I'm having the same conversation that I'm going to have with the investor whenever the real deal comes, but I'm having it today. The biggest mistake I see people make is they wait to tell the world that they're doing multifamily, and then they get the deal under contract. They're like, man, I found it. This is the one, but nobody knows who you are. Like not even your family, your relatives, or your inner circle know that you're doing this. And now it's hey, I have 60 days to get all of the money, and we just met. And do you want to invest 100 grand? Like that's a weird conversation. Like it works. Like I've raised some money from that way, but the biggest way that I'm raising money is just establishing the relationship today, setting up the one-on-one Zoom call, walking them through, hey, this is all the deals I'm looking at, just so you can see. I'm in Florida. I'm looking at value add stuff. Sometimes the deal like the Levi comes out brand new. It underwrites just like a value add deal. It fits my return metrics. What questions do you have? How does it work? All of the vetting happens on these earlier calls. That way, whenever you actually call the investor, hey, like I missed on 10 because of how disciplined I am and it's just the market. This is the one. This is the one. Are you ready? That is the biggest piece of advice that I could give for anybody looking to raise capital.
Yeah, I mean, it makes a lot of sense because it just follows the simple rule of be proactive, right? If anyone's ever read Stephen Covey's 7 Habits of Highly Effective People, being proactive is one of the main base rules that he has there, right? And so you're being proactive with those relationships. You're doing it also in a strategic way. You're not just sending, for example, like these random annoying little updates. It's, hey, I was looking at this deal. I was too disciplined to buy this deal. But, if we would have got it at this numbers, this is what it looks like. That provides shows everybody that you're a hunter. You're looking at the deal. You've got access to the deals. People know that you're underwriting them. They understand that you're disciplined in your underwriting. And it just builds these little stepping stones of proactive trust and then allows you to, when you do have the deal, be quick instead. So you're not being reactive. Like you said, once you get the deal, now you're being reactive. You're being very proactive in your approach and your communication to raising that capital. Okay, so you're being proactive on the communication side. Great. Now talk me through the rest of raising that capital.
Yep. So I've syndicated every deal I've done. I'm not going to do a blind fund until we have an earmark on our track record that we can talk about. We have an asset manager, acquisitions guy, an IR team. I'm building out a very similar approach to it. We're still going to syndicate these deals. So what that made, just for everybody to understand, syndication versus a fund. Syndication is I find the deal first and then I raise the money. A fund is it's blind. So you give me a check and then I tell you what deal we invest into after. You got to have a lot of experience and track record to do that. So I'm establishing a relationship with the investors as deals are coming out. And then once I know that a deal is going to land, like I have a signed LOI moving into the PSA, then hey, Mr. Investor, I just got a new deal. I'm working on my documents. I wanted to send you over the stuff preliminary just so you could get the first look. There's a lot of sales involved into it. So I want to create momentum out of the gate. That way I can leverage it later on in the raise. So if I'm raising $1 million for a deal and I can get $300,000 or $400,000 of commitments for my first reach out as I'm getting the PSA signed, it creates this big momentum that I can then tell to the rest of the investors that are now looking at it. Hey, Mr. Investor, we just went under contract on the deal. I sent it out to my best investors first. We already have 40% of the entire raise already committed, and we haven't even had a signed PSA. I'm thinking by the time that I have the documents, like and we're just creating some urgency around it. So I sign the PSA. I pay my attorney to set up the securities documents. I get a PPM. I get an operating agreement, subscription agreement. I'm creating an investor packet with a lot of pictures and a very clear and simple business plan. Most investors that are investing passive do not know, like, your job is to be the sophisticated guy to run the project successfully. Their job is to make a lot of money and invest with you. They don't know what IRR is. Most people do not know the actual deep, weedy definition of IRR. So explaining it very simply in a picture format. This is the current condition. This is what we want to do to it. And these are the projected returns. This is who we are, why you should trust us. Most of the people already know. Packet. I send the packet over to them. Hey, anybody interested? Cool. If you're interested, send it to them. If they show interest, I put them on a little sheet. I put them into my pipeline and I send them all the stuff. And then we do a one-on-one Zoom call after they reviewed it. And then we get to a decision.
Boom. Boom. I love it. One key thing is simplicity is magic when you're telling the story, right? Because what simplicity does too is it shows that you actually deeply understand, as the one who is putting the deal together, as the one who is really underwriting the deal. If you cannot explain it in a simple manner to the people that are going to invest, you got a problem. It's probably too complicated, right? There's one of my great mentors. He builds 2,000 homes a year. 2,000 homes a year. And he told me, yeah, he is a beast. He told me that if they can't he learned it from his father. He said his father told him very early on, and then he taught me, if they can't do the numbers on the back of a napkin, then it's probably too complicated for them. Now, that's the baseline numbers. Of course, when you're doing a big deal, you go in and you have your valuations and you have, like you said, you want to make sure that if you have a difference in insurance, right? Like if you projected insurance to cost $500 a unit and then it's $1,000, there goes
it's the entire deal. More deals have fallen apart because of interest or insurance in Florida than interest. And interest is a really big issue, but insurance is a bigger issue.
Yeah. So I think that I love that you talked about when you're going to raise that capital, that you're proactive, and then that you also tell the story in a really simple manner through pictures and through simple, clear calculations.
Yeah, I'll go a little bit deeper on why I know that to be very, very, very true. When I was working at Grant's office, so you can be dubbed as like a really good salesperson there, and you can go all the way into the sales training. Or I'm not a really big salesperson. I am a real estate guy by heart. I'm the deal. Like, I got the deal bug is what they call it. So I've always I wanted to get better on the phone so I could raise more money, so I could make more money. But I didn't want to be the salesperson because I didn't feel really great about it. So I opted to go the route of becoming like the real estate person. So I would beyond what everybody else was doing for training. I was going through the extra courses that he has, and I was looking at every single line item on the underwriting. I'm asking questions. So I would go into the investor, the accounting office with the CFO and be like, Susan, we have a really, really, really big investor. They're looking through the underwriting and they have a bunch of questions about it. Who can I sit with and talk them through it? I was the investor because I just wanted to learn. But they didn't know it. And so I took the real estate role, and eventually all the real estate players would get passed to me because I could speak the lingo. I got to the point where I was over complicating it because I wanted to be that person. Hey, the IRR is this over this, blah, blah, blah. And I'm like, I wanted to be the guy that shoots. And my stats actually started going down. Like I'm a big data guy. I look at my graph all the time. My graph was going down. I'm like, why? Why is this happening? I'm getting smarter. I'm getting better at real estate. You'd think that I would be raising more. It's because I was overcomplicating it. And so I had my one-on-one. We looked at the graph, and he was like, what's going on? I was like, I don't know, listen to my calls. And he's like, dude, like, I'm smart, but like, you're overcomplicating it to me. And I know if you're doing it to me, you're not going to raise any money. So we left that one-on-one call with, pitch the deal as if you were talking to a fifth grader. Explain it so that the fifth grade level can understand it simply enough. And then if you have an investor that's also deep, weedy details, then you can go down and hang with them. Like, they will test you with that, but you should always start super high level.
Yeah, I love it. And one other thing I'd add to that, anybody who has money, that has the amount of money that you really want to get it to invest, they value their time more than anything. So the quicker you can get to the point, the faster you can get to telling the story in the best, simplest way that's clear, the better off you are. If you just for me, if somebody starts going and going and going and going and going, I'm like, you're losing me. I'm thinking about, I got 1,000 things I'm trying to create and do. I'm
Yep.
gone. But if you come to me just direct, hit me, boom, I can be like, yeah, let's do it. Done. Let's go.
Yeah.
Right. And so I would say those two together, make it as good as a fifth grader and make it as fast as you can. Make it an elevator pitch, because
Yeah.
those two together, for people who are decision makers who have the capital, that they're going to
So
appreciate that.
I'll give you a funny story, and then we can go wherever you want. But
Come on.
the 152 unit deal that I did in Missouri, it was seller finance. It was a steal. We bought it in an 8 cap, financed it with 5% money, and there's $500 of upside. I raised $1 million.
Just so everybody break that down real quick. For somebody who's trying to follow that.
Yeah, that's my fault. I'm just okay. So we paid $7.75 million.
Yeah,
that was the purchase price for 152 units.
Yep, it's a steal.
And the in-place going-in cap rate was an 8% cap rate with the existing in-place income as is. Rents were $600. We paid $50,000 a unit above the 1% going in. We took rents to $1,035.
Wow.
Without like staying full, not doing a ton. It was just owned for 50 years. But the guy that I partnered with that found the deal, he was pegging the seller for 4 years every year with a letter. Like, hey, man, it was just good timing. So I came in to help raise some money on it, and I texted. I didn't even call. I just took a general text, and I said to all my current investors, this is not, in all caps, this is not a normal deal. It is a unicorn, ... I'm only sending it to 15 people. Let me know. And we raised $1.5 million in 17 days from start to finish.
Boom. And that's all you had to raise, right? Because you only had to raise 1.5.
Yeah.
They carried the rest. You created a win-win situation, because if you think about that, if they're the owners, so you say you bought it for $50,000 a unit and it rents for $1,000 now?
Today. Yeah.
So if anybody remember what we said about the 1% rule, they're doing the 2% rule, just so everybody
to manage expectations, you will not find it. Like, it's going to take 4 years of pegging the right person and a really good relationship.
Yeah. But just so, I mean, if everybody's understanding, that's a beautiful thing. So the text was true, right? It was a unicorn deal. But what I understand you did on that, so you bought it for $7.75 million. You had to bring in $1.5 million, raise $1.5 million, and then the owners actually became the bank. So it was seller finance, which is a great win-win situation for them as well, because now they continue to have the benefit of that monthly income without the headache of the management, etc. And so you could see what Gabe and his team did. They structured, the guy you partnered with was on them for 4 years, which a lot of people, they give up, right? They forget. They don't have the discipline. They don't have the structure. I bet you that guy has a great sales sheet that he just hits like a system,
Yeah.
Even that's amazing. But you structured the deal in a way that was a win-win, right? You made it a win for the sellers. You made it a win for your equity partners, and then it was a win for you guys as well. I love that deal. That's a really good deal. How do you win then, Gabe? For somebody who's listening, like, heck yeah, I love this. I love this idea.
Yep.
How does Gabe make money?
Yeah, we've created $2.5 million of net worth in the last 31 months through carried interest of our ownership in the deals for raising the money and being a partner in it. It's real, it's real net worth. We just did the 28 unit deal because of the net worth in our schedule of real estate. All of these deals have big paydays, and we have asset management fees. So we have reoccurring of $200,000+ a year just from the deals, and then we have multiple millions of dollars of net worth created into these. So, like my first deal, the 55 units that we did in June of 2022, we're done with the business plan. We're waiting for rates to continue to come down and insurance. That's a big thing here in Florida, and we're on a 7-year fixed loan. We don't have to sell, but we're done with the business plan. We should, depending on interest rates and insurance, we should have an exit in the next 12 months. And that we put $50,000 in, me and my wife personally. We wanted to have some skin in the game while raising some money from the investors. We put 50 in. The LPs should hit a 1.7 to 1.8 in 36 months or less. And our $50,000 will come back close to 400 between the LP investment, 50 going to 85, and then the GP fees that we've taken along the way. So the investors get to double their dough or close to it, and then the sponsor gets to grow their capital very, very quickly. That's the dirty little secret on why syndicators and fund managers, raise 95% of the equity.
Yeah, and just I want to break down how that's done is through an LP and a GP, and tell us about that.
So the GP fee, LP is passive. They just write a check.
Stands for limited partner.
Yep, limited partner, so completely passive. They write a check. My goal is to hit a double on the equity. 100 in, 200 out. On this one, it's going to be closer to a 1.6 to a 1.8, depending on what we exit for.
Still very good. You cannot get that type of return elsewhere while still getting a 6% cash on cash, just so everybody understands.
Yes, so we've been paying 6 and 6.5 on that deal. We would be at 8 unless the insurance. That we
six is good. Six is
I love six.
Six is really good.
I love 6. I have way too many people in the Midwest that are dinging on me. It's like, hey man, Florida deals are nice, but like look at what I'm getting over here. We can go into it later, but we put 50 grand in, and that 50 grand as a limited partner position will come back close to 80, call it 85 grand. So that's 85 grand that's coming back as an investment, as a limited partner. The general partner side, we took an acquisition fee. That was about 40 grand paid to us at the time of close. We take asset management fees. I think it's only 2 grand a month. We haven't taken a single asset management fee because we don't necessarily need it, because we have a business now that kicks off a decent amount of cash, and we've been letting it sit until the exit. And then we have the big payday is whenever we sell the building, we do an 80-20 split. So our split's 80-20. 80% of the profits goes to the limited partners for putting up all the money. 20% of the profits comes back to the general partners. Now, I have a partner in that deal. It's a 75-25 split on it. I raised 1/4 of the equity. He raised 3/4 of the equity. I found the deal, so it was it was a win-win. Yeah. So we own total, I think it's 6 or 7% of the entire deal. Of the GP splits that are coming back to the partnership, there's about $1 million score to the GPs. Of that million, 250 gets allocated towards me. 750 goes back to the investor. So 250 plus asset management plus acquisition plus my LP position. 50 in, 400 out.
The point is this, guys, it pays to be the deal maker. So if you're excited about this and you want to really get into it, just understand it pays. You have to put the work in. It took Gabe 5 years of just absolute grinding to be able to do it. Then he jumped off the cliff and learned how to fly. And then now you were seeing him today at 27, just smashing it. But it pays to be the deal maker, especially if you can do it in a way that creates win-wins for everybody. One other thing I want to touch on, we talked about real estate in general, and it made me think of it because I saw this German mark. But we touched on real estate, the benefits from a cash flow side, the benefits from an exit side, but there's also so many other benefits in buying real estate. Can you touch base on, just as you're talking to investors, some of the other reasons why we would put money in real estate versus the stock market or something like that?
Yeah, well, it's fixed income. So if we look at like assets and the way that things trade, you can go into a tech, you can go to the stock market and go to tech. You have no idea what you're doing. It's a piece of paper, and you hope that it goes up, at some point in life, and it's like an Amazon or a Facebook. Then there's fixed income assets that are like lower risk. They're not as valuable because it's not as crazy, but it's fixed. It's consistent income that comes in every single month. So I look at like apartments is like Netflix. The Netflix has 500 million users that pays $10 a month, and it's like a contract. Apartments is we lease space to people that pay on a contract. So it's a fairly low risk. Now there's all types of risk within real estate itself, but the asset class itself is low risk and it's tangible, meaning it has an address. You can look it up. You can see its history. You know who owns it, and you know it's real. So it's tangible and fixed income every single month. People are going to cancel Netflix before they cancel paying their rent. That's already been proven. Yep. And the upside is where a lot of the money is made. But depreciation and tax benefits is one of the biggest reasons why my bigger investors invest. Like they look at it as almost like a bond. It's like, okay, I'm going to hustle really, really, really hard in my everyday business, make a lot of money. It doesn't even have to be a lot. If you don't want to go down the active route, you don't have to. Like if you love your job, you love your career, and you don't want to make a giant change, just figure it out how you can make some more money and invest it. But they look at it as like a bond. I'm going to invest some money. It's going to earn a fixed amount of income where I don't have to think about it. It takes care of my family. It takes care of the basic living needs that I want. So it's like time freedom. It's actual true financial freedom. And then it lowers their tax burden by like a ton because of the depreciation benefits of it. And then the upside. So it's like if you take all four and you compare it to, I'm going to go in, like I've never bought a stock. ever. I don't know how. Like if you told me to go short, I don't know anything about the stock market, but I can't imagine putting 100 into my phone. I can't call somebody. Like I can't call the CEO of Facebook and say what's going on. I
No.
don't have any real look inside of the operation. Uh, Going direct into private in the syndications, you have real access to real investments. It's typically reserved for institutional players, the wealthiest families in the entire country. That's
Yeah.
who it's typically reserved for.
Yeah. And now with these communication platforms, you see what Grant Cardone's doing, especially him. He's buying these institutional assets and giving everyday people an opportunity to own a piece of it, which I think is a really, really cool thing. I think the other thing, I couldn't agree more with you on each one of those. The other thing I love about it, because it's a real asset, it's an inflation hedge. So as they print more money, this is the German mark, crazy, right? This is a German mark, and it's a $20,000 German mark. During World War One, you couldn't even buy a loaf of bread with 20,000 German marks, right? So as they print more money, what happens to the imaginary Fugazi money that we trade? Well, that devalues, but your hard asset, because you've now taken that money and put it into a hard asset, it's an inflation hedge as well. So it protects your money. It helps grow it. You get the cash flow, like you said, the fixed income. You get the depreciation, which if you do that correctly, the depreciation that you can get from investing in apartments, if you do it smart, and other assets, it is almost unbelievable through using bonus depreciation what you can do to offset your active income that's happening here. So it makes a lot of sense for these people who are really good at making money, who have extra money that they need to, invest, to then do it in real estate, because you get this depreciation that you can use as well, which is phenomenal. So, I just love the real estate vehicle, and you touched on it as well. It's shelter. I mean, shelter is one of the most human basic needs, and so it's always going to be a priority for people to have a place to put a roof over their head, and it's a skill well worth learning. Right, being in the real estate game, in my opinion, is a skill well worth learning, because it has so much opportunity, because it has so much value. So, I couldn't agree more with you on that. Gabe, I'm really curious, like what's next for you guys? You've
Yeah.
accomplished so much in 3 years. What's next?
Yeah, so we have an investor community called the Deal Room, and everything integrates. So I run a very similar setup like Grant. We have educational stuff. It's not the same like salesy. It's not the same in my opinion. We're more relationship driven. We're trying to add people to our network and help people do deals. So we're building a machine that raises 200 million bucks, $200 million a year from retail investors, and allocating it to the best opportunities that are presented across the country. And we're going to partner with fantastic operators that have a proven track record. And I could go on and on, but we're going to keep doing deals. Like I don't have my goal was $1 billion by 30. I don't care. Like I know we're going to hit $1 billion at some point, and I know we're going to hit 5 and 10 at some point. I look at this as a sport, like private equity investing, doing the deals that we're doing. This is the sport that will pay you the most, and the one that you can play the longest without getting hurt. I've chosen my new sport.
I like it. That's exact. It's crazy how many entrepreneurs have some sort of sports background. That's why I figure, like, any parents, if you want to really set your children apart just from a pure ability to compete in life, I think doing it through competitive sports is key, because it gives them the opportunity to reflect, like, hey, you got to compete. You got to ask yourself what went well, what didn't go so well. How am I gonna improve? You have to deal with, if you're in sports, you have to deal with competing against people, losing, getting better, training. It fortifies this growth mindset. If you become a really good athlete, you're going to become a really, really good business person as well. You just have to then learn the technical skills. Like you said, this is your new sport.
Yeah.
You have the foundation of the growth mindset, how to compete, how to become a little bit better version of yourself every day. And you're just doing it in the real estate game. So it's called the Deal Room. And so tell me a little bit more about the Deal Room. It's a community-based education.
So a very simple setup. It's a community above all else. I hate the word course or program or like
Sure.
buy my course and all this stuff. We have education. We have 250 hours of education. We meet twice a week, every single week. That's the main bulk of it on a Zoom call. Every Tuesday we do something educational, or I'll have a guest speaker on. Every Wednesday we do deals. So I'm a big learn through doing. Like, don't give me a whiteboard. Give me a deal with a T12 and a rent roll. Let's tear through it and let's get an offer out. Kind of person. So,
Sharpen the sauce.
yeah, I mean, that's how That's how you learn. Like, people learn through data points. If you look at 100 deals, you're going to be a whole lot better and understand what's actually happening inside these deals. You're going to have a whole lot better understanding of what a good deal is versus only looking at five. So I'm a big action taker, like take just massive amounts of action, and it's like destined to work at some point. That's the same approach that we take. If you guys want to do deals, you need to learn, and then get right. The biggest barrier is people, and that's why I'm so driven on the community aspect. Anybody can learn. Like, it's an effort driven thing. If you have the right information and you go through and you suck a little bit at the beginning and you work on getting better and better and better and better, you'll become good, and you can have the skill set of a deal maker, which nobody can ever take away from you, by the way. That's like, I value skill set so much. um, you'll always have that limitation of how many deals can you do, of what size. Like, I have my own limitation of how big of a deal I can do right now because of my experience, but bigger problems is my network. I can't get into a $40 million deal yet. I'm comfortable at a 10 to $20 million range because of your network. So that's what I would say. Your network is by far the most important, but the foundation, it's like, I don't know anything about building, so don't judge me on this, but I'm guessing the foundation of what you build is probably the most important thing on making sure that the structure above it is actually good to go. That's what I believe in any business or real estate or pretty much relationship. If the foundation isn't strong and not clear on where you're going, it's going to be a short ride.
I couldn't agree more. I couldn't agree more, and that's extremely accurate. And then sharpening the saw. I like that you guys are in that community, then training every Thursday on underwriting deals, because there is no way around it. Repetition is the mother of skill. It's the father of perfection. It's what you have to do to be able to, become really, really good at it. I mean, they have books that studied how do you become a master. Well, you have to do 10,000 hours of not just random work, of quality work, of
Yeah.
true quality work. So I love that you have that community. And people, please, if you want to get into it, I mean, go check it out. It's called Deal Room. I'm
Yep.
going to get
Yep.
in the Deal Room, man. I'm
I'm
going to.
gonna have you. So I'm gonna have you on as a guest. I'd love to have you. We have about 50 to. We had 80 people on Tuesday, and then 50 on Wednesday. I would love to have you on. But just go to multifamily on Instagram or at the Deal Room on Instagram. I bought both of those to make it super simple. Just go follow, and you'll figure it out.
I love it, man. Well, thanks for taking some time out of your day to drop some knowledge on us. It's really, really cool to see somebody like you, a young entrepreneur, making it happen, paving the way, and then also sharing what they're learning, right? I think that there's a huge, huge movement. Some people think that the social media side of things is a bad thing. And actually, I was included in that for 5, 6, 7 years. I was like, hey, this is a
Yeah.
distraction. It's kind of like, it's just a distraction. It's not good. I didn't have any social media. And then I flipped my mindset on it, and what I realized, because, well, like you said, your network, right? If it wasn't for social media, you and I would never be talking, and you and I are going to continue to be able to build a really good relationship. I'm going to learn from you. You're going to be able to learn from me because of these social platforms that are now available. So, I highly encourage people to go follow Gabe at multifamily on Instagram. Get into the Deal Room and watch as he gets to $1 billion. I guarantee you he will. It's not if, it's just when. And I can't wait to watch that unfold, my friend.
I appreciate it. Thank you very much.
Thanks for coming on. And with that, we will see you on the next one, baby. Cool.